Hello traders, today is the 21st of July 2013 and the time in London is 12:21, in New York is 7:21 a.m. And the title of this video is a zigzag correction. We're going to discuss a wave theory applied to the zigzag correction. Alright, so the first thing that a lot of traders are forgetting when we are talking about the wave theory is that it is a theory. Because a lot of traders try to use the wave theory like a wave science or like a wave magic or like, alright, whatever they think, okay, but it is a theory. Alright, this is very important. Whenever you are applying the wave theory, you must understand that it is a theory. The reality of the market can be completely different. Economy news, market leaders, fundamentals can change the dynamics of the market at any point. Another key trader must understand that the wave theory is fractal theory. So you may count 5 waves on one time frame or see a corrective wave on another time frame, but the bigger cycles, okay, will influence what is happening on the lower time frames. Very important. So here I'm on a yearly chart and we're going to discuss, okay, a wave theory applied to a zigzag pattern. All right, very, very important. The next thing, if you are watching this video, I would like traders to focus carefully and to try to understand what I'm trying to communicate here so that they may avoid repeating the same mistake, being too excited or enthusiastic about Elliott wave theory. Is only the beginning, okay, but it's more serious than that, okay? But pay attention. So we want to know that it is a theory. We don't want to forget that it is a theory. Very, very important. All right. The wave pattern is fractal pattern. So sometimes a trader may count a wave on one time frame. Okay. It may happen to be that it's a mistake. The wave count can be wrong on that time frame. Looking at the chart, the trader may think that this is a second wave, or this is a third wave, or this is a first wave. There's nothing wrong with that. But if the trader stops only on that time frame, which means using one single time frame with the wave theory, the trader is likely to make a mistake. So when you are counting a wave, you must use different time frames to validate your wave count, especially if you're about to make a decision or buy or sell. You want to investigate your wave count by comparing it to different time frames, maybe even compare it to other financial instrument. All right, very important. The third thing that trader must not forget when we are talking about the wave theory is that the markets, talking about the trading triangle, the markets can change the dynamics of other financial instrument. So talking about the trading triangle, we say the market first, the sector before the individual financial instrument. Professionals know that and they follow it carefully, but very often a lot of traders, ordinary traders, will learn the wave theory. They understand it or they know it. Okay, they know that what is a zigzag pattern, what is okay, flat correction, what is running flat correction. But one thing that they are forgetting is that when they are about to make a decision, they forget that it is a theory. They forget that the wave theory is a fractal. They forget that okay, the market, the trading triangle, and they go round. It's not because they don't know about the wave theory, but they do not understand how to use it successfully. And this is what we are talking about today. So I hope at the end of this video, you will be trying to apply these okay, guidelines so you may avoid okay, making mistakes. Okay? Very, very, very important. It is a theory. The wave pattern is fractal, and always apply the trading triangle. Continue with the zigzag correction. The zigzag correction can take place in the second wave, fourth wave, and after a motive wave. A zigzag correction is a zigzag in the form of a zigzag. So price goes down, price went down, price goes down. This is a zigzag here in this section here where I'm rotating my cursor. So price move up first, and then it pull back a bit, and then try to go up, meet more resistance, and come back down after an up move. This is a zigzag after an up move. It's form of A, B, C. From here to here, that's the A corrective wave, corrective subwave of the zigzag pattern. From here to here, that's the B, the B subwave of the zigzag, okay, corrective wave. From here to here, that's the C corrective wave, or is the C sub corrective wave of the zigzag pattern. All right, so A, B, C. The A corrective wave of the zigzag pattern can be divided into 5 subwaves. 1, 2, 3, 4, 5 down here. So this portion here from here to here, which is A, can be divided into 5 subwaves. From here to here, which is the B corrective wave of the zigzag, can be divided into 3 waves. From here to here is the C corrective wave, can also be divided into 5 waves. So in total, the zigzag can be for the case of a complex zigzag, or in the normal subdivision, okay, a zigzag can be divided into 13 subwaves. 5 waves during the A corrective phase, 3 waves during the B corrective phase, and 5 waves during the C corrective wave. A, B, C. This is a zigzag, okay? All right? But this portion here can be divided into 5 subwaves. It is not an impulsive wave, it's a corrective wave, but it can be divided into 5 subwaves. From here to here, this a B corrective wave can be divided into 3 waves. The B corrective wave of the zigzag is correcting the A corrective wave. All right, but you can see that this A corrective wave is correcting, in fact, the previous trend down. But this B corrective wave is correcting the C corrective wave. But the whole A, B, C is correcting the previous trend. The inverse is also true in a downtrend. Price went down, and then we have A, B, C. In this scenario, again, this A of the zigzag can be divided into 5 subwaves. This B subwave of the zigzag can be divided into 3 waves. And this portion from here to here, that's the C subwave of the zigzag, can be divided into 5 subwaves. There was a trend, and then there is a correction. That's how it formed. So if we don't see an impulsive wave before we see a zigzag, we may think of, a double zigzag or something else. In normal condition, pay attention carefully. You may watch other video on our website because we have been discussing about Elliott wave, and we can discuss everything in this video all together. So there was an impulsive move, a dynamic bullish move. All right, it's not a corrective wave. Price went up bullishly, strongly, okay, and then there was a slowdown, low volume, low volatility, and the price went down first time, tried to go up but was pushed back down again, and it's playing what we call a zigzag pattern. So now we know the internal wave. The internal waves are what we call also sub waves. This is what we are talking about, the fractal patterns of the wave principles. Though you see like this, it can be subdivided itself. We can go on division, okay, of each wave. All right, so it can be divided into 5 waves, the A corrective parts and the B corrective. The next thing, talking about the wave theory. Ladies and gentlemen, now we are talking about theory, all right? So do not forget what I've said from the beginning of this video. We are discussing a theory right now, yeah, on a piece of paper. No, not during trading, but we want to know it. This is about knowing, all right? The next thing, talking about the theory of the zigzag, very often, pay attention carefully, the B subwave of the zigzag will fail to go above the 50% of the A subwave of the zigzag. So this is the A subwave of the zigzag. Very often, I draw my line a bit too far. Trying to rectify that now. You see that the B corrective wave very often will find a resistance around the 50% of the A corrective wave. I don't want to repeat myself many times, so then I can replay the video to, okay, if you don't understand what I'm talking about. So this is A corrective wave. Very often the B will fail to exceed the 50% of the A corrective wave. All right, this is the theory. Nothing can stop the B corrective wave to go even to 60% or 70%. Sometimes you can go to 60%, you can go even to 70%, but very often, this is what we are talking about, okay? Most of the time, you see that it will stop at 50%. So do not be surprised to see going above the 50 up to 60 or 70 before coming down. There are more to the zigzag pattern, ladies and gentlemen, but talking about the theory, this is what is happening. So a zigzag is formed of 3 subwaves, A, B, C. The A can be divided into 5 subwaves. The B can be divided into 3 waves, and the C can be divided also into 5 waves. The B very often will fail to exceed the 50% of the A corrective wave. Now you see, I can even teach this to my child, and he can learn it by heart and say it. It's about knowing, all right? But there are more to this. The next question that trader will ask, how, okay, does the zigzag form? Why we have this pattern? Now we are trying to master the zigzag. So when you start asking questions, why we have 3 waves? Why is it 5? Why is it 3? Why is zigzag? What is zigzag? Okay. So now you want to understand the difference between the expert and the ordinary trader is that the expert understand what is taking place. They can also filter out if there is a distortion of the zigzag pattern. But remember what I said from the beginning of this video. All right, the theory, it is a theory, and the wave principle is fractal. And also, we must always use the market, the trading triangle. The market is the first thing that we want to check. So you see a zigzag pattern in the second wave. You can see a zigzag in the second wave, in the fourth wave, and also at the end of a motive wave. I'll come back to that very soon. All right. So now we see a zigzag. All right. We understand what is taking place. All right. And we know what is a zigzag. Okay. So what is taking place here? All right. What is taking place? So as I say here, so we have if we have a downtrend, all right. So the price went down. This is what we see after a downtrend. All right. What is taking place during a zigzag pattern? All right. So the price was bullish first, okay, you see, so in this scenario, price was going down, people were buying, they want to buy, all right? So other traders who missed this opportunity to buy here are waiting for a pullback. They are patient, they say, okay, it's gone without me, I didn't enter there, a lot of people make money, a lot of noise in the market, people say they make a lot of money. So now there is a profit taking this session here, probably this is a resistance, and people start taking profit, all right? The first people who join the trend start taking some profit. They are not stupid. It's very important to take profit. Don't leave it on the table all the time. Bank it. So start taking profit by rolling it down, okay? Very often, ladies and gentlemen, when those who were buying before take profit, they don't want to violate the 50% of the previous price. So from here to here, they will be careful. They will take. Usually, very often they take like 50%. They don't like to take more. If they take too much, they will take up to 60%, between 50 and 60%. This is the theory also, all right? Very often they do that, all right? So now price reaches 50% or 61.8%, people, okay, start buying again. People who didn't buy before or people who did buy before want to buy for the second time, all right? But remember, suppose this session here is a first wave, all right? When do we see the first wave? The first wave we know the pattern, the guidelines. So there was a downtrend, all right? And then there was a consolidation. Then we see a breakout, which is the first wave, okay? So though the first wave is the first bullish signature, now the bear are still in the market. So there was a bearish season before, then there was a consolidation. The bear are still the dominant force. Now there is a bit of change because, all right, the bulls start pushing it, and they push it out of the consolidation zone, all right? Now, the bear who did not believe that the bearish season is over would like to sell. As they see these people taking profit here, they say they would think that the bearish session will continue, and they will start selling together with these people here. So there is a group of traders that were buying here that would start taking profits. By taking profit, they have to sell. Other bears that were still in the market start selling together. Price going down, price reaching this point, more buyer coming in, buying. Those who missed this opportunity here start buying here at the end of A, price going up. But something else has happened. At this point in time, you have to understand the 50% is a psychological price level. 50% retracement is a psychological price level. The bear understand that. The bull also understand that. Price going up to the 50% of the previous move to the downside. Some traders will take profit. As they are taking profit after this B move, they're selling. The bear also coming against that selling. They say, I told you, the bear season is not over yet, and they start selling again, forming the C session. But as the price reaches at this level, more buyers coming in, and the price may continue the previous trend. All these are beautiful. This is the wave theory. But now we are going a little bit deeper to understand what is taking place, because these are market participants making decisions, buy and sell. Okay, that's why the pattern is formed. Now we want to understand how the pattern is formed. The key point trader must understand is that the 50% level for any move is a psychological price level. Trader must watch it carefully. Let's go back now to the chart itself, which is right here. This we are looking at okay, Merck and Co. Okay, American stock listed on the Dow 30. I like Dow Jones very much. As you can see here, we are on a yearly chart. Okay, can you see? Okay, yearly chart here. Here it is, the yearly chart. All right. Because why I choose the yearly chart, because the wave pattern is flattened. I want to know what is happening on the heart from straight away, so I don't fool myself on the daily chart alone. A lot of wave traders stop on the daily chart alone, and they get into trouble. And I don't want to do that, so I'm pushing my curiosity a bit too far, so I may see the bigger picture. All right, there are more to this, but I will keep my mouth shut for now. Okay, so I'm going to go very fast, so we can see first wave. All right, talking about wave theory applied to the zigzag. Okay, a correction. All right, a zigzag pattern. So first wave from here to here, this is what I have. I can't see more data than this, so if I can see 2 years chart, maybe I'll see something else. Okay, so you can see that the price went all the way up to this level very fast. You may disagree with my wave count, that's okay. So do not be afraid to say that okay, this is what I see. It's okay. All right, you have to make your own decision. So feel free to disagree with me, okay? So we see first wave, second wave, third wave, fourth wave, and fifth wave. I need to tell trader that in year 2000, can you see here, we have the tech bubble. Yes, a correction has taken place in the year 2000, all right? So, you know, in this session here, very important, if you are using Elliott wave, you must know this 2000, 2009, 2008. You must not forget that if you are using the Elliott wave, all right? So now, I see 5 waves. 1, 2, 3, 4, 5 waves. Okay. In fact, I can go like this. All right. I don't want to do that. I'll put it here. Okay. 5 waves. All right. But now look carefully here. I'll leave this drawing on the chart. I have a reason for it because I may come back to it. Okay. I hope it doesn't disturb. So now you see here, price went down. Okay. I will call out that move to the downside into green. We are talking about wave theory applied to the zigzag pattern. All right, pay attention very, very carefully. Now, what's happening here? All right, you see here the cycle, the bullish cycle, or the multi-wave. The multi-wave is formed for 5 waves, 1, 2, 3, 4, 5, which is an impulsive wave. The multi-wave is an impulsive wave formed for 5 waves. Okay, 1, 2, 3, 4, 5. This is our multi-wave. I'm going to use now my Fibonacci retracement tool that I will apply to the whole multi-wave from the beginning to the top. You can see that I didn't go to the top of the candle. I'll stop on the closing price here. All right. Where is the 50% of our multi-wave? I'm going to draw a line there, horizontal line. It was not my intention that this video is long like this, but because the subject we are discussing is very important, I'll let it run. Okay. So Bear with me, please. Okay, moving on. I will call, okay, I'll use this time pink, all right. So this is the 50% of our motorway from here all the way up here, the 50%, half, okay, halfway of the move from here to here is what we call 50%. If you think it's a complicated word, 50% retracement is, okay, price went from here to here, the middle point is the 50%, okay, all right. Below that level, we have the 60%, so I put it there into black. Very often, pay attention, I'm going to zoom into the price now, pay attention. The 50% is here, the 61.8 is here, all right, this is about Fibonacci. In fact, the price went up from here to here. If you pull back to the pink line, the price has lost 50% of the previous move. If you come down to the black one, it has lost 61.8% of the previous move. All right, so people have taken 50%. If the price reaches the pink line, if the price hits the black line, they have taken 61.8% profit. You can see that the price went even down to 78% Fibonacci retracement level. It's all about how much profit people have taken. I will color that into blue. All right, now you see it, okay? So there is a group of traders in the market that will always buy after the price reaches the 50% and the 61.8% zone. So they see the multi-way, price display 5-way, price pull back to the 50% and 61% zone. There is a group of traders, because we are talking about market participants, the price will not move if people do not buy or sell. So we don't want to forget that behind the price, there are human beings making decisions. Hedge fund, investment bank, ordinary traders, crazy traders, speculators, momentum traders, market makers. People are making decisions. So there is a group of traders that will always buy with the price pulled back 50% to the 61.8% zone. You can see the tail of this candle here, that people bought it here before. The price went down all the way. You see how it touched it here? Can you see on your chart? Zoom into this one. Yeah, it touches 61.8. Quickly grow to close up. People place orders here. Very often, these people will place orders there, waiting for the price to touch it. As the price pulling back down, it reaches those levels. These orders will be filled quickly. Price quickly close up, but it was not finished. All right. So you see, all right, and then the price went back down again. Return back to the 61.8, and this time the smart money prefer to buy 78% because a stock that is 100, okay, let's call it 75%, that is $100. Now, for one reason, it's now $25. That's 75% discount. It's like Christmas Day, all right? Bank holidays in London, they give you a nice discount, 75% discount. The quality is still the same. It's not something cheap, it's something low quality. It's still, the quality is still good. The company is still excellent. You check the fundamentals, you check the cash flow, you check the competition, you check the management. You see their projection into the future. All right. You are happy about the market itself. This is what we say at the beginning. Do not forget that. And smart money will buy. They will buy if the company still have a future, the management is still solid, they have an excellent market share, they are dominating their competition, or they are handling it at least, they will buy. So one group will buy at between 50 and 61.8%. Another group will try to buy at 78%. The smart money will always buy, prefer to buy at the lowest price if they know that the company is excellent. They don't care about the technical so much, but if they know the value is very, very good, they'll buy here. All right? So, to continue with this discussion about the weight theory applied to the zigzag correction, ladies and gentlemen, let's continue with this discussion because our intention is to simplify the weight principle and to make it accessible to ordinary traders, but also to allow traders to know, but more importantly, to understand what is taking place. Very often, let's go back again to my drawing. After an impulsive move, when traders see the price coming down like this, especially I want to say something to TSCWSY0A traders. So prior pullback like this, you see a cycle that is about to begin here. That's why we say the TLCWSY is a very, very simple tool. Does not use Elliott wave, does not use any complicated formula. Very simple trading tool. But when you see a cycle that has begun, so you are in a cycle, you see at this point the cycle will stall, and the TLCWSY will let you know that the cycle has stalled if you just following it as we said it in a simple manner like a child. Okay, tell you that the cycle is stalling. So you know that the music is changing. But here, a lot of, let me stress this very point to a lot of traders. A lot of ordinary traders like a pullback like this, straight down like this, and then from here, all the way up. Sometimes it's not like that. In the case of the zigzag, the price will pull back like this, so trader may receive a buy signal. The buy signal it's not a wrong signal. It's a valid signal that they receive. Nothing wrong with the signal at all. Then the price starts going up. Traders forget the 50% of this pullback. Do not forget the 50% of the pullback. What I will say to traders quickly is that when you see a pullback like this, after a bullish move, and you see a pullback like this, and you receive a signal to buy here, all right, draw the 50% of the pullback. So the 50% is half the middle point of the pullback. If the price does not go above the 50% of the pullback and find a support above it, the price is not completely bullish. Let me say this again to you. When you see, so the price went up first, okay, and then pull back. And here you receive or you see a bullish cycle, the price start going up. Do not forget the 50% retracement of this pullback here. If the price does not go above that 50% and find a support above it, all right, it's not completely bullish. All right, this is what you need to remember. Note it down, write it on your fridge. All right, note it down so you don't forget it, because you can easily forget it. On the other hand, price went down and rally up a bit. You receive here a signal to sell. The signal is valid. Yes, you take it, or you see a bullish cycle. You are TLCWSY trader or your TLCW24 trader. You see it, you buy. Price start going down. You are happy. But suddenly, price return back up. You say, what's going on? The signal is wrong. The signal is not wrong. It's a zigzag correction. Get a lot of traders into trouble. To avoid this kind of messy zigzag correction, one can, so you see, so price went down, there is a rally, you sell here, do not forget the 50% of the rally, the movement from here, 50%. If the price does not, all right, if the price does not find a resistance below the 50% of the rally, it's not completely bearish. It's not completely bearish. Do not forget the 50% of the previous move. Very, very important. Just simple. This is just a psychological price level that traders are watching all the time. So in this scenario, as you can see, as the price pulling back in straight line like this, a cycle has begun because we're on a yearly chart. The traders start buying, but you see the cycle has fell again. Cycle price return back down, even down below the 50%, and continue movement to the downside. At this point, the strategy that trader must use, price pull back, you buy, highlight the 50% of the pullback. That's what's happened here. All right. If it fails to find a support above it, it's still bearish, and people sold it down. You see, the smart money understand that, sold it down. Okay. All right. Now you see here. Here again, pay attention to this section. So this is what we call the A corrective wave after the motive wave. So we see 1, 2, 3, 4, 5 wave. This is the motive wave. Now you see this straight line move down, was not in straight. So you see it went down first, people bought it, pulled back up a bit, and they pushed it back down. All right. Now price come down. It's a straight down here, green line. Pay attention to this green line. Okay. So this is our A corrective wave of the zigzag. I'll continue to draw more line on this chart. If you are following me, you will not get lost, okay? And then we have another move, and then we have another move down to this level. This is a zigzag correction. All right? This is a zigzag correction. Beautiful zigzag correction, okay? A, B, C. You can see that the C went just a bit below the A. It must go below the A, all right? It went down a bit below it before the price closed up here. So, but you can understand that as the price pull back to this point, trader will, if you receive a signal to buy, and you are buying, do not forget the 50% of this move. That's where the price did stop. I will show you now. I'm going to use again my Fibonacci retracement tool from here to here of the A, you see. There. Where is the 50%? My police traders, 50% is here. Pay attention to the line I'm drawing now. Exactly there. The power of the 50% or the 50% retracement, or the power of the simple moving average 50. Do not forget that. So here you can see this is 50% of the A corrective wave of the zigzag. Here it is. So as you price pull back like this, you receive a cycle has begun or whatever, you receive a bullish signal here, you are buying, you just draw quickly straight away the 50% there. You know that if it fails to find a support above the 50%, it's still bearish. So price reaches this level, you may decide to take profit because you know that it's a hidden resistance. You can just bank profit. All right? You just bank it. Don't force it. So if you were here, you see smart money, they just take profit now. Price drop down big time at 50%. Okay, believe that? All right? You see now? So the theory says that if the B corrective wave very often will start 50%. It's nothing magic about it. Is that because price went down, if the price is still below the 50% of the move that went down, it's still bearish. But if it goes above it and finds support, the bullish momentum is diminishing. It's just very simple. All right? Very simple. All right? There are more we can say about the wave theory applied to the zigzag correction. As you can see on this chart, we have a multi-wave formed of 5 waves. 1, 2, 3, 4, 5, followed by a zigzag. A, B, C. This move from here to here can be divided into 5 waves. This move from here to here can be divided into 3 waves. The move from here to here, which is the C subwave of the zigzag, can be divided into 5 subwaves. Now, once you see that, you must now check the S&P 500, which represents the market. Use the trending triangle. Check the fundamentals, okay, relating to Merck. Before I close this video, ladies and gentlemen, I want to show you something that has happened this week regarding Coca-Cola. The importance of checking economy news and checking Google Finance and Yahoo Finance, very, very crucial. Last weekend, so a week ago, I was telling traders, I draw a line, traders that are following us on YouTube and also on our website. I posted a video on our YouTube channel, Joy Trio channel on YouTube. And I draw a line around a level of 4.1. And I said to trader, priority to bullish signal above 4.1, priority to bearish signal below. Look what's happening. This is this week, the week that has closed now. So you see how the price, I said to trader also this is a resistance level. The price for the resistance went down big time before coming down. Why the price went down? This is not a technical issue. I was thinking that this thing will finally support above it, but it didn't. It just, there was a, earning news relating to Coca-Cola. That was poor performance for Coca-Cola. The market sold it during the week. It went down before it found a bit of breath to catch up quickly. But this is just to show you why, you see, if it gap down, you see. This is the news, boom, down. So, very important, if you are using the wave theory, remember that it is a theory. The economy news, the fundamental can change the dynamics of the wave theory. All right? Very, 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 very important. A trader must not forget also that the wave theory is a fractal theory. The wave patterns are fractals. All right? So now we see a pattern on this yearly chart. If you can see a higher time frame, that would be great. That will give us a bit of more information. So if we made a mistake now, we will find out, the cycle is, no, it can't be. So we will see something else. But with the information that we have, that's all we can see on this chart. Trader must not forget also the 50% of each move. So you receive a signal to buy the previous move, draw the 50%. So anytime you buy after a pullback, draw the 50% of the pullback. Anytime you sell after a rally, draw the 50% of the rally. Remember that some trader will always buy between the 50% and the 61.8%. But if you are doing that, draw the 50% of the pullback. If you're doing that, you will avoid stupid mistakes and enjoy your trading, okay, your trading decisions, all right? So the zigzag is form of three waves, three subwaves, A, B, C. The A subwave or the zigzag can be divided into 5 subwaves. 1, 2, 3, 4, 5. Though it's a 5 wave, it is a corrective wave. The A of the zigzag. And the B is a corrective wave of the A, being divided into 3 waves, 1, 2, 3. And the C, a continuation of the A, is also 5 waves to the downside, correcting the bigger cycle. One can see a zigzag in the second wave, in the fourth wave, and after, okay, the motive wave. The motive wave is the 5 wave that form a trend, and after that we may see a zigzag. Another thing before I close this video, traders, there are different type of corrective wave. Sometimes trader may see a completion. Okay, so we see now a zigzag being completed. Trader will say that's the end of the correction. How do you know? How do you know that this is the end of the correction? All right. We have also a complex zigzag, which is ABC, X, ABC. So sometimes trader will get so excited and say, this is the end. I found my best zigzag. Now this is what George has said. And they load it, If the signal has changed or if the music has changed, so they don't want to change their step, and they stay there and look in the air, but you are the decision maker. You must make a decision, okay? I've said enough about wave theory applied to zigzag correction, and I hope you have learned something from it, okay? And more importantly, that you will put it into use, okay, to make excellent decisions. Until the next time, enjoy yourself and be very happy. We are the TSTW SYS 008 traders. Speak to you soon.